Hello everyone, very good evening to all of you. Myself, Saloni Gupta, welcome you all in the session of Oliveboard. Please confirm me my audibility and visibility. Is everything perfect? Can we start today's session? Yes, I guess everything is perfect now. So yes, from today onwards, we have to start our new module, that is module B. We have completed module A, and total 6 units were there in Module A, starting from basics of management till controlling. We have completed each and every important concept related to such topics, such unit. So in Module B, we will be starting with our Unit 7. Today, we have to complete Unit 7, all the important concepts. And the name of the module is that is Sources of Finance and Financial Strategies. So in module A, we have seen that how to manage a business. Okay, we have seen the management perspective, how we plan our activities, okay, how we organize into similar nature of groups, similar nature of activities together. If any mishappening occurs, how do we control that? Okay, how we read the market phenomena, the market structure, all the internal as well as the external factors. So all these things we completed in our module A. We have read all these things. See how to manage a proper and healthy business. Now in module B, what we have to learn, what we have to study that how we will going to procure our funds, how we will going to use our finance in various sectors, what are the sources of funds, all these things, all the things related to finance, related to money, you will going to study in this particular module, that is module B. Various types of decisions, how you will going to take decision for any kind of project. If you are thinking to invest on any project, how you will going to decide that, what are the techniques you will follow, that everything related to such things we will study in this particular module, that is module B. And today we have to study that what are the sources of finance, how many types of capital are there, what are their work. So this thing we will study today. So let's start the session. And if you are new to this channel, I highly request you to subscribe the channel. If you feel that my videos, my sessions are helpful to you, if you are gaining any knowledge from my sessions, kindly like the video and share it with others as well. Now, let's start with the session. So, sources of finance. Sources means the places from where we can arrange our funds, where we can arrange our finance. Clear? So, there are basically two types of sources basis of time, that is the time period, the sources of finance time period, and basis of ownership means the owner. On the basis of time, we have two types of sources of finance. The first is short term and the second is long term. Short term means what? Short term is a finance which is less than for 1 year, less than a year. Whereas long term sources of finance are those finance which are more than for a year, more than for a year, for 5 years, for 10 years, for 15 years, like this. On the basis of ownership, again, we have two types of sources of finance. That is the owner's fund. Owner's fund means what? I'm the owner of the business. I'm using my own capital for the running of business. So this is what owner's fund. Second comes borrowed fund. Borrowed fund means what? I need some more amount of capital for my business. So where I'll be going? I'll be going to any financial sector, any banking sector, borrow such funds. So borrowed funds are the funds from such institutions from where we can borrow the funds which we need in our business. Now next comes equity capital. What is equity capital? Who are equity capital, equity shareholders? Suppose let's take an example. Okay, this is a person named A And this is a company, let's say ABC Limited. Now, this particular person, okay, wants to invest in this company. So what he will do? He will going to invest in this business. He wants to do an investment, so he will become the investor. Now, if he wants to invest in this business, so business will give him what? If this person will invest, he will give first what? He will give rupees. And in return of that shares, ABC Limited will what they will sell their shares to this particular person A, and in return of these shares, the particular person will invest in rupees to this ABC company. Now, when he is investing in this company, then he is taking a part of the ownership. And when this person takes the part of the ownership, this person becomes a equity shareholder. Now read this bookish language. Equity capital represents what? They represents ownership in a company when any investor, this is the investor, purchases shares. This investor is purchasing the shares of ABC Limited, and instead of these shares, he is investing in this particular company. They become part owners and have a claim on the company's asset. Now he has become the ownership of the company. Now he can claim all the assets of the company, all the profits of the company, all the bonus of the company, the dividend of the company. So he or she can claim all these things. So equity capital refers to the fund raised by a company through what? Through the sale of shares. Equity capital are such type of capital. They are such type of funds which is being raised by a company through the selling of its share. In is the amount remaining after selling all the assets and paying out the liabilities. So equity capital have different features. Okay, they are the ownership of the company. They are the owners of the company. They participate in all the matters of the company. They participate in the profits of the company, in the dividend of the company, in all the internal affairs of the company. Equity capital, or you can say long-term loans, each have a distinctive advantage, and the choice between depends on a company's specific circumstances. Why business will prefer equity capital over long-term loans? Why we prefer equity capital over the loans? Because in equity capital, you don't have to pay any kind of obligation. If you are taking the help of loan, then you have to pay interest. But equity capital, in your if you are taking the help of equity capital, you don't have to pay interest on a regular basis. There is no obligation to repay the interest. Risk is shared because equity capitals are a bit risky one, and the risk will be shared to every person who is in that particular business. They have their own experience, expertise. So they bring what? Valuable expertise, network, mentorship, because they are highly risky. If such investors are in this case, if such investor is investing in this particular business, so definitely this investor has some years of experience. He has a lot of business ideas. He has a great business model. That is why he is investing. And this company is seeing that, okay, this person is very profitable for my business. Okay, let's sell our shares to this particular person and let's make this person as equity shareholder. So they have expertise. The financial burden is less. If you are taking the loan instead of equity capital, you have to pay interest. You have to pay the interest principal plus interest amount. Whereas in equity capital, you don't have to pay any kind of interest. Why? Because they are owners of the company. You only have to pay the dividend profit to them. The ratios will be improved by relying more on equity can lead to stronger debt to equity ratio. So if you will rely more on your equity shareholders, then what happens? You will going to take your debt less, and if the debt is less, then debt to equity ratio will become more stronger, and hence it will tell the credit worthiness of the for future financing. Flexible growth, there is being a flexibility for long term growth and strategies. Why? Because there is flexibility that if any business, like suppose ABC Limited, the example which I have taken, this ABC Limited, suppose year 2023, 24. 2024-25. And let's take one more example, 2022, 2023. In this year, he made a profit of 1 crore. In this year, he made a profit of 80 lakh rupees. Now, in this coming year, he is making what? He is making a profit of, let's take an example, 60 lakh rupees. So as you can see that the profits are decreasing. Okay, so decreasing, they are decreasing. The profits are being made in a decreasing order. So equity shareholders will also get a profit in a decreasing order. They will get the dividend in decreasing order. So they have a flexibility. It is not that every month, every year you have to pay them a certain profit. No. As the company earns the profit according to the profit level, according to the loss level, they have to pay the profit. If the company makes a loss for a certain year, then they will not be given any kind of profit, like and vice versa. Now, what are internal accruals? Internal accruals are, see, when a company makes a profit, after this profit, it depends on the company that whether the company is distributing the profit as dividend to its shareholders or they are keeping it as reserves. If the company is keeping all the things as reserves, then they are their internal accruals. And how profit is being calculated? You have sales. If you will deduct your variable cost, you will get contribution. If you will deduct the fixed cost, you will get EBIT, that is earnings before interest and tax. Less interest, earnings before tax. Less tax, you will get earnings after tax or PAT after tax. It means this is the amount, this is the real earnings which you will going to divide among your shareholders or you will keep it as reserves. So the amount which you are keeping as reserves is your internal accruals. As a measure of financial prudence, no company can would like to distribute the entire earnings after tax to shareholders. No company will distribute all of its earning to shareholders. They will keep a few portion of their earnings as reserves and which is known as this retained profit are internal accruals of the company that rise out of the cash profit. There are also dividend distribution rules. Okay, and after when you get your PAT, that is what your retained earnings. And these retained profits are what internal accruals. Now, what are preference capital? Again, in the same manner, the equity capital, there are preference capital also. Preference capital, preference shareholders. So capital, it is the money company raises by selling what? By selling its preference shares to all the investors. Similarly, in likewise equity shares, they also sell their shares to the investors, and investors become a part of the preference shareholders. So if you will see this word preference, preference means what? Such investors will get a sort of preference. What preference? Whenever company makes a profit, okay, in this profit, first the dividend will be given to whom? These preference shareholders. Whatever earnings is being left, the first dividend, the preference is given to them. After that, whatever is left, then it will be divided among equity shareholders. The preference shares type of share capital that gives investors, they have certain rights over a company's asset and earnings. They have only few rights, not all the rights which equity shareholders the company give them. No, they only have a negligible or few rights. As the name suggests, the holder gets what? A preference. Preference of what? A dividend. In case as well as payment in case of liquidation. When the company liquidates, first of all, the payment is given to whom? Preference shareholders after paying all the debts, all the liabilities. First preference is given to preference shareholders, then equity shareholders. So they are kept one level up from equity shareholders. So what are its features? They have a dividend preference. They get a fixed dividend. Dividend can be fixed or variable. If it is variable, it has to be mentioned in the document, or else most of the time the dividend of preference shareholders they are fixed. Liquidation preference, when the company gets liquidates, these are paid before common shareholders. Now, what are common shareholders? The other name of common shareholders is equity shareholders. Convertibility. These preference shareholders can be converted into equity shares after a specified time. After a time period, they have the chance to convert into equity shareholders. They have the voting right, a few voting right, or a negligible voting right as well. Redemption rights. Some preference shares may be redeemable. They can redeem. Okay, a specified time is being mentioned. That is, the company can buy back the shares of these preference capital. They have a fixed maturity. Preference shares may have a set maturity date. That is, they can be redeemable. A fixed time period is being mentioned. Now, what are debentures? Debentures means what? Simply debentures means debt. Debt means loan. Word debenture, it is a derivation of the Latin word debere, which means to borrow. So this section is important. According to Section 2, subsection 30 of Companies Act, debenture includes debenture stock, debenture bonds, or any other instrument of a company. Okay, that determines what a debt, and a debt means what a borrowed money or loan. So when company takes a loan from such debenture, then they become the debenture holders of the company. And these debenture holders, they get what? A fixed interest payment because they provide a sort of loan to the company. And in return of that loan, company pays what? A fixed interest rate that is paid to these debenture holders. So debenture is document that acknowledges a loan and contains what terms and condition of the loan. The same term and condition what the loan carries, the same they will also carry. In loan, what company has to do, if a company takes a loan from a bank, they have to pay the principal amount plus the interest amount. In the same manner, a company has to pay to its debenture holder the rate of fixed interest to them, including what the interest rate, repayment schedule, a particular time is being mentioned over there. So debenture holders, they become what? They become the creditors of the company, and the company has the liability to pay them a fixed rate of interest. And likewise, preference shareholders, they also don't get voting right, unlike shareholders means the equity shareholders. In equity shareholders, they get a voting right to participate in the company's matter, but whereas debenture holders do not have any kind of voting right to participate in any company's matter, in any internal affairs of the company, that is general meeting. Now, what are the features of debenture? Again, they are instrument, an agreement or deed. Everything is written on that agreement. Okay, what type of loan you are asking, the convertible loan, non-convertible loan. Then the borrowed fund is at you will get a interest, a fixed rate of interest should be determined over there. A fixed time period should be determined over there. No voting right is given. Stake in the company, they will become what? Debenture holder. They will become what? Creditor. They have the options with the issuer and options with the investor. So these are the few features of what? Debentures or debenture holder. Now, they have borrowed funds. This is what the company borrows from them, the debentures. Fixed rate of interest, they have a fixed rate of interest. Like if the debenture holder's interest is 10%, it means if they have given 1 lakh to the company, so you have to pay 10% as interest in this 1 lakh rupees. Compulsory payment is there, like wise loan. In the same manner, we pay a loan, we have to pay interest to these debenture holders. Proper secured, these are secured as unsecured. Means you can keep as collateral as a security, and you can also take the loan as unsecured, means no collateral is being put when taking the loan. Redemption, these can also redeem, that is company can buy back the shares after a certain date, buy back shares after a specified period of time. And again, they have no voting rights that is being mentioned over here. Now, this one term in our module B, Unit 7, that is Foreign Direct Investment, FDI. So FDI again, it consists one more word, that is FPI. It is similar to this word, foreign direct investment and foreign portfolio investment. So direct, see, whenever you are investing in any country, okay, you are investing, suppose you have got a chance to invest in particular project of this company. Okay, this company is being situated in USA. Now, you are saying that this project is very good, it will give me a good return. I will be earning more in USA because you know that in USA the dollar is being appreciated. The rate of the dollar is high than the Indian rupee. So foreign direct investment means what, you are making a control in that company. If you want to make a control, if you want a control of that particular company situated in this particular country, then you are doing FDI. If your intention is only to earn profits from that company, if your intention is only to earn profits from that company, then what you will do? You will do FPI, that is foreign portfolio investment. So FDI is what, when a company or individual from one country invests money in a business to another company. When company invests the business of another company situated in foreign country, that is FDI. For example, like factory setup, okay, in doing any kind of operations in that country, and allows investor to have control over the business. FDI, it gives what? It gives the control to that business, and from this control, they will make a huge. FDI is what? It is again, it is divided into two routes, the automatic and government. In automatic, okay, full-fledged freedom is given that you can go and you can do the business. Whereas in government route, okay, after a percentage criteria, you need to take what? You need to take the permission of the government. Then only you can go and you can invest in other country. So in government route, the permission is required. Whereas in automatic route, no permission is required of the government. No permission is required of government. It refers to an ownership stake in the foreign company project made by an investor. Such as if you are investing in any other foreign country for the purpose of control, that is FDI, and if you are investing in any country for the purpose of only just to make profit, that is FPI. So this is very important. Foreign direct investment in India is governed by whom? It is governed by a FDI policy which is announced by the government of India and the provisions made under Foreign Exchange Management Act. So this FEMA came after the replacement of what? FERA. Before it was FERA, now it is FEMA, Foreign Exchange Management Act, and it was Foreign Exchange Regulation Act. In FEMA, we have total 49 sections, and in FERA, there were total 81 sections. Clear? So, yes, I hope you have enjoyed the session. Everything is being clear to you. If you have any doubt, you can ask me. And tomorrow we will start our new unit, that is Unit 8. And again, we will cover some of the important topics from this particular unit. So, if you like the session, please kindly like the session. If you think that the sessions are helpful, then subscribe the channel as well. Let's meet tomorrow sharply at 8:30 p.m. We will starting our another unit, that is unit number 8. Till then, take care everyone. Goodbye. Keep studying. Keep watching.